my name is Schyler Church. I am a California real estate broker as well as a member of the education department at Accredited Real Estate Schools. We offer those course requirements to be eligible to take the state exam in California, but also to make sure that you are prepared to pass that state test. So if you are interested in checking out our courses or any of our exam preparation options, I have the link posted below. But if you're liking our YouTube channel, make sure to like our videos and give us a big thumbs up, to then also subscribe. So that way we keep producing new content on our YouTube channel. And today we're going to talk about sample questions that the DRE has actually released. So these are released DRE questions. That is the only ones that the Department of Real Estate has ever released, but they don't provide answers. So they tell you that you have to actually find these answers. Well, I'm going to go through 25 of these questions and give you the answers so you can see what will be covered on the exam and how proficient you are with the material. So let's get to it, and let's start with some of these sample questions that the Department of Real Estate has released for that California real estate state exam. Number 1, judgment liens differ from mechanics liens in that A, mechanics liens are created by statute. B, mechanics liens could take priority earlier than the date they are recorded. C, judgment liens are voluntary liens. D, judgment liens are not enforceable until recorded. So, judgment liens and mechanic liens. It has the word lien in it, and as you know, that is an encumbrance based on money. What is the difference, though, between these? Well, the biggest thing to know about is, remember, there is a saying that comes first to record is first in right, with 3 exceptions: a mechanics lien, taxes, and subordinated loans. Those allow you to actually take priority before the date that they're actually recorded, depending on certain circumstances. So a mechanics lien could be recorded or take priority before it was actually recorded. That is something that is very different than the judgment lien. Now, so let's kind of break it down a little bit more though. So mechanics liens are created by statute. No, those are not. That's where if you do not pay your contractor or subcontractor, they can file a mechanics lien against the property to get paid. There are limitations on the amount of time frame though that can pass. Then what we're talking about is mechanics liens could take priority earlier than the date they are recorded. So that is true. The mechanics liens can take priority earlier than the date that they are recorded, depending on when the work commenced. So even if the mechanics lien was recorded after, maybe they were not paid, and so they want to now get paid for it, they could record it, but it's going to take priority from the date that it was actually, the work was started. So it could then take priority before it, whereas a judgment lien cannot do that. But let's verify that C and D are not correct. So C, judgment liens are voluntary liens. No. Judgment liens are involuntary liens. Pretty much all liens are involuntary except a trust deed or a mortgage. Judgment liens are not enforceable until recorded. No, they are enforceable even before that they are recorded. So that is a judgment. Remember, it goes attachment, judgment, rate of execution. So those are enforceable. So the best answer is B. Mechanics liens could take priority earlier than the date they are recorded. That is the best answer and the correct answer. So let's move on to question number 2. Tax delinquent real property not redeemed by the owner during the 5-year statutory redemption period is deeded to the A, city, B, county, C, state, D, school district. So we're talking about tax delinquent real property. So when a property owner has not paid their property taxes, they are given a 5-year statutory redemption period where they are still in possession of the property. But if they do not pay it back in that 5-year period plus the late fees, then that property would be deeded to the state of California. So it would be deeded to the state of California. So C would be the correct answer. 3, the maximum commission a broker may charge a seller for the sale of residential income property is A, set forth in the real estate law, B, negotiable, C, no more than 10% of the total sales price, D, determined by local custom. Well, the biggest thing you should know about commissions, they are completely negotiable. They are not set by law. If you can get 10% of the sales price or more, great. You can also work for without a commission or without payment as a gratuitous agent. So a commission is completely negotiable. And it's also because it's negotiable, it must be disclosed to the principal of the fact that commissions are not set forth by real estate law, and they are completely negotiable. Now, brokers might say that they only want to charge this certain amount, so that's their going rate, but they cannot state to a principal that that's because that's what the law states. That's what their going rate is. But commissions are completely negotiable. So the correct answer is B, negotiable. 4. In a typical percentage lease, rent is calculated as a percentage of A, assets of the lessee's business, B, net sales of the lessee's business, C, gross sales of the lessee's business, D, net taxable income of the lessee's business. Well, in a percentage lease, these are usually used with stores. Sometimes the biggest times is they might be like in malls for the stores that are within a mall. It could be used for discount stores. A lot of different places or businesses could use a percentage lease depending on what the landlord prefers, because a percentage lease lets the landlord participate in the sales of the tenants. So, and the biggest thing to know is that the percentage lease is calculated based on the gross sales of the tenant's business. Another word for tenant is lessee. The landlord is the lessor. So, in a typical percentage lease, rent is calculated as a percentage of the gross sales of the lessee's business. So, the total sales before any deductions of expenses. 5. The position of trust assumed by the broker as an agent for a principal is described most accurately as A, a gratuitous relationship, B, a trustor relationship, C, a fiduciary relationship, D, an employment relationship. So we're talking about that position of trust assumed by the broker as an agent for the principal. So we're talking about that agency relationship. When you have that agency relationship, you have this type of duty and obligation to your principal. That duty and obligation is a fiduciary one. So it's described most accurately as a fiduciary relationship. Remember, this is one of utmost care, integrity, honesty, confidentiality, competence, all of those good trigger words of standard of care, this high standard of care you owe your principal. So the best answer is C, a fiduciary relationship. Then we have 6. The Federal Housing Administration's role in financing the purchase of real property is to A, act as the lender of funds, B, ensure loans made by approved lenders, C, purchase specific trust deeds, D, do all of the above. So we're talking about the FHA, Federal Housing Administration. So when you think of FHA, the word that should come to mind is that they insure loans. They insure loans. They don't guarantee loans. They don't actually originate the loans. They insure the loans by lenders that are approved. So the best answer is the Federal Housing Administration's role in financing the purchase of real property is to B, insure the loans made by approved lender. They do not originate. They are not the lender. And they do not purchase specific trust deeds. So they do not operate in the secondary mortgage market. They just insure loans. 7. Which of the following best defines encumbrance? A, the degree, quantity, nature, and extent of interest which a person has in real property. B, the use of property by a debtor as security for a debt. C, any action taken relative to real property other than acquiring title. D, anything which affects or limits the title to real property. So, we talked about an encumbrance a little bit earlier in this video, so hopefully it's coming to mind. Well, remember, an encumbrance is something that limits title to real property either based on money or use. Knowing that, let's look at it. So A, the degree, quantity, nature, and extent of interest which a person has in real property. No, we're not talking about that. We're also not talking about the use of property by the debtor as a security for a debt. We don't care if it's owner-occupied or a non-owner-occupied property. We're not talking about that. And Any action taken relative to real property other than acquiring title? No. So we are dealing with title when it comes to encumbrance, but we're talking about something that could affect title or limit the title of real property. So the best answer is D. Anything which affects or limits the title to real property. 8. Which item would an appraiser use to arrive at a net income for capitalization purposes? A. Cost of loans against the property. B. Allowance for rent loss and vacancies. C. Federal income tax. D. Reserve for appreciation of buildings. So we have to know about the capitalization approach, which is just another name for the income approach. Well, that income approach, we have that formula of IRV, income divided by rate equals value. We have to know how to calculate that net income. Net income and net operating income are used interchangeably for state exam purposes. So what do we know about calculating that net operating income? Well, we do not take into consideration debt service. So the cost of loan against the property, that is something we do not take into consideration for net income. We do take it into consideration for cash flow. Now, allowance for rent loss and vacancies. Yes, that is something we take into consideration, and that's how we get our effective gross income, and that's then how we determine our net income. So yes, B looks to be like a good answer. C, federal income tax. Nope, that's not something that we take into consideration for net operating income. Also, reserve for appreciation of buildings. No, that is not correct. So now that we've dissected all the answer options, the best answer is B, allowance for rent loss and vacancies. That is what is used to arrive at net income when we're talking about capitalization purposes. A clause in a trust deed stating that the rights of the beneficiary shall be secondary to a subsequent trust deed is called A, an acceleration clause, B, an alienation clause, C, a subdivision clause, D, a subordination clause. So we're talking about a clause in a trust deed that allows the rights of a beneficiary to be secondary to a trust deed that is recorded afterwards. So giving priority to a subsequently recorded loan. Well, what clause is that? Well, let's break it down. So an acceleration clause, that is making it to where the loan balance becomes due and payable upon the occurrence of a certain event, usually on the sale of the property. An alienation clause, that is for being able to sell the property. Then we have a subdivision clause. I have no idea what they're talking about that. That's made up. And then we have a subordination clause, which is when you're able to switch priority or the position of a trust deed in regards to who would be paid if there was to be a foreclosure or for the proceeds, how they'd get paid. So subordination clause allows a secondary or subsequent trust deed to take priority over a trust deed that was recorded beforehand. So if the subordination clause was in the original trust deed for one that was originally recorded prior, and another loan then gets on the property, they could take priority because that first trust deed had the subordination clause in it. So the best answer is D, the subordination clause. 10. Private restrictions on the use of land may be created by A, private land use controls, B, written agreement, C, general plan restrictions and subdivisions, D, all of the above. Well, private restrictions, let's see here. They can be created by private land use controls. They can also be created by written agreements, as well as the general plan restrictions in the subdivision. So D, all of the above, can create private restrictions on the use of land. 11. A listing agreement must contain the elements of a contract, which includes A, competent parties, B, unlawful object, C, unspecified consideration, D, being notarized by a notary public. So a listing agreement must contain the elements of a contract. So what are the essential elements of a contract? We know they have to have the capacity to contract as well as be a competent party. There needs to be mutuality, lawful objective, as well as sufficient consideration. Knowing that, the best answer would be A, competent parties. Competent parties must be is an essential element of a valid contract and one that needs to be for a listing agreement. It has to be of lawful objective, not unlawful. Has to be for sufficient consideration, not unspecified. as well as being notarized by a notary public is not required, does not need to be notarized. So the best answer is A, competent parties. 12. A quitclaim deed conveys only the present right, title, and interest of the A, grantor, B, servient tenement, C, grantee, D, property. So a quitclaim deed falls under the deeds that we're talking about. And for these types of deeds, we have a grant deed, we also have a quitclaim deed. Well, they use the same terms when it comes to the parties, the grantor and the grantee. The grantor grants to the grantee. There's not a such thing as a quitor or quittee, only a grantor and grantee in regards to a quitclaim deed. So who is the one that actually is conveying those present rights, title, and interest? Well, the person who is giving and granting to the grantee. So the grantor. The grantor is the one who is actually conveying those present rights, titles, and interests. The grantor is giving to the grantee. 13. If a $218,000 $400 investment in real estate generates gross annual earnings of 15%, the gross monthly return most nearly is A, $3,276, B, $2,820, C, $2,740, D, $2,548. So we have to look at this and figure out what's the gross monthly return. So we have this investment and we have the gross annual earnings of 15%. You can pretty much use the DRE formula here to calculate it. And we need it to though be at a monthly number, non-annual number. So what you can do is you can multiply $218,400 by the 15% and then divide that number by 12. So once you get that number, it actually equals 2,730. Well, that is most nearly 2,740. Yes, it might be a little $10 difference, but that is the closest number. 2,740 is the correct answer because it's most nearly to the 2,730. So we take the DRE formula. So we have income divided by rate, which is 15%, equals value of 218,400. Do some simple mathematical operation. We end up ultimately multiplying the value of 218,400 times the 15%, and then we get a number of 32,000. It was 32,000 and something, and then that would then divided by 12, and so it equals 2,730, which is most nearly C, 2,740. Okay, moving on to the next one. 14. You are a California real estate broker. A prospect is referred to you by an out-of-state broker, and you consummate a sale by you. You want to split your commission with a cooperating broker. Under California real estate law, A, you may pay a commission to a broker of another state. B, you cannot divide a commission with a broker of another state. C, you can pay a commission to a broker of another state only if he is also licensed in California. D, none of the above. So this is just a fancy way of saying a referral fee. Can you give a referral fee to an out-of-state broker? You as a broker in California can pay referral fees. You can pay to another broker. So a broker to broker is allowed, and that's also allowed from a California broker to an out-of-state broker because they're at the broker level. As a broker, you cannot pay to a salesperson. You have to compensate directly to the broker. But in this particular case, they're talking about a broker in California paying a referral fee to an out-of-state broker, which is completely okay. So the best answer would be A, you may pay a commission to a broker of another state. "15. Edison sold his land with an easement appurtenant for a road. The deed to the buyer contained an adequate description of the land, but it failed to make reference to the easement. The buyer, A, takes title to landlocked property, B, has a clouded title, C, forfeits the easement to the servient tenement, D, has the same right to the easement as the seller did." So we're talking about an appurtenant easement. Pertinent easements run with the land. Well, when it runs with the land, it automatically transfers with the land. So if there was an adequate description of the land, that is sufficient even if the easement was not actually referenced. the easement would still transfer with the land. So the buyer has the same right to the easement as the seller did. D would be the correct answer. Edison sold his land, even though the easement pertinent was not specified because there was an adequate description of the land. The appurtenant easement runs with that land and would automatically transfer to the new owner. 16. If the broker, while acting as agent in a sale of real property, misrepresents the principal's property to a buyer, the broker may cause the principal to be subjected to A, rescission of the sale by the buyer, B, a court action for damages by the buyer, C, tort liability, D, any of the above. Well, if the broker who is acting as the agent in the sale of the property misrepresents the principal's property to the buyer, the broker may cause the principal to be subjected to the buyer deciding to back out of the agreement, so rescission of the sale. That's totally an option. They also might have a court action for damages by the buyer. So there might be a court action instituted by the buyer for damages because of this misrepresentation, which is just a nice name of saying lying that happened by the broker. Tort liability, yes, this is something that we're actually talking about more on this. This is tort liability, so we're talking about like civil law, not criminal. And that could be a thing as well. That would be something that could be subjected to the principal due to this broker's misrepresentation. So the correct answer is D, any of the above. 17. An instrument which usually transfers possession of real property but does not transfer ownership is A, a trust deed, B, a sublease, C, a security agreement, D, an easement and grant. An easement grant. That's not even something you need to know for the state exam, because an easement and gross is something that they'd usually ask you about. But an instrument that transfers possession, usually transfers possession, but does not transfer ownership. So we're talking about the possessory part of it. Well, usually a lease will transfer the possession, and a grant deed would transfer ownership. Well, out of these answer options we have, a trust deed, that is something that is to be the security, to be the collateral for promissory notes. A sublease, yes, a sublease is a type of lease. So that could be one. A security agreement, no, that is used when there is a loan needed for personal property. An easement grant, don't need to know about that. So the best answer is B, a sublease. This is something that would transfer possession rather than ownership. As a matter of practice, the escrow holder is authorized to A, order the termite inspection and authorize any corrective repairs to be made. B, advise buyers on best financing available in the marketplace. C, amend the commission instruction form at the request of the listing broker. D, call for funding of buyer's loan proceeds. So, escrow holder, escrow officer, escrow agent, just the same name. What are they authorized to do? Well, they are not authorized to order the termite inspection and authorize any corrective repairs to be made. They cannot do that. They can also not advise buyers on the best financing. That is something that's beyond their scope. They can also not amend the commission instruction form at the request of the listing broker. The listing broker has to be able to submit their broker demand. The escrow holder cannot do that. But the escrow holder can call for funding of the buyer's loan proceeds. That is something that the escrow holder is authorized to do. So the correct answer is D. 19. Community property is property owned by A, churches, B, husband and wife, C, the municipality, D, the community. So community property is a type of vesting held, it's a type of concurrent ownership, and the concurrent ownership has to be between two spouses to be able to hold property as community property. So what is the example of two spouses? Not churches, husband and wife, those are two spouses. The municipality, no. The community, no. So the best answer is B, husband and wife. 20. An apartment complex costs $1,800,000. It brings in a net income of $12,000 per month. The owner is making what percentage of a return on the investment? So this is another example where you can use IRV. So we have the net income of $12,000 per month. Well, per month is $12,000. At an annual number, you would multiply it by 12, and you'd get $144,000. So you would get that. Now we're looking for the rates. Ultimately, so we have $144,000 divided by the rate equals $1,800,000. To get this operation, we swap the place of the rate value with the rate variable with the value variable, and we would then end up dividing 144,000 divided by 1.8 million. And due to that, we get an 8% return on the investment. 8%. So it's important to remember to multiply the monthly number to make it annual. So you would having an annual income of $144,000. That would be your net income on an annual basis per annum. And then we would divide it by $1,800,000 to get the return on the investment, which ends up being 8%. 21. A person holding title to real property in severalty would most likely have A, a life estate, B, an estate for years, C, ownership in common with others, D, sole ownership. So we're talking about vesting when we're talking about severalty. So is it held? Is it one that's held as like sole ownership, or one that is concurrent ownership that's in common with others? Well, when it's in severalty, it is one person. So it's sole ownership, one person. Sole ownership. The correct answer would be D, sole ownership, when we're talking about severalty. 22. Under the federal truth in lending law, two of the most critical facts that must be disclosed to buyers or borrowers are A, duration of the contract and discount rate, B, finance charge and annual percentage rate, C, carrying charge and advertising expense, D, installment payments and a cancellation rates. Well, when you think of the federal truth in lending law, the first thing you should be thinking of is the annual percentage rate, that APR, the APR. But it has to show the true cost of credit to rent money, so the true finance cost. So it needs to show the finance charge and annual percentage rate. Those are the two most critical facts that must be disclosed to buyers and borrowers in regards to the federal truth in lending law. So the correct answer is B, finance charge and annual percentage rates. 23. Appraisals of single-family dwellings are usually based on A, capitalization of rental value, B, asking price of comparable houses, sales price of comparable properties, and D, the assessed valuations. Well, when we're talking about single-family dwellings, we have to look at what are the three approaches that are used. We have the income approach, we have the cost approach, and then the most readily usable approach is the market data approach. The market data approach is used primarily for single-family homes and vacant lands. And to do and use the market data approach, we look at comparable properties and the actual sales price of those comparable properties. So appraisals of single-family dwellings are usually based on C, sales price of comparable properties. Sales price. We actually care what a buyer purchased the property for. 24. A contract based on an illegal consideration is A, valid, B, void, C, legal, D, enforceable. Well, illegal consideration, remember, it has to be of sufficient consideration and also for lawful objective. Well, a type of illegal consideration would make the contract void. It would be a void contract. It has to be of sufficient consideration that would be able to be upheld in a court of law. So it has to be of legal objective. So if it's illegal consideration, that would make it a void contract. Then we have 25. The California Standard Form Policy of Title Insurance on real property insures against loss occasioned by A, forgery in the chain of recorded title, B, liens or encumbrances not disclosed by official records, C, rights of parties in possession of the property, D, actions of governmental agencies regulating the use or occupancy of the property. So when we're talking about the standard form policy of title insurance, we're talking about the owner's policy, which is the California Land Title Association. So that CLTA policy. We're not talking about the extended lender's policy of ALTA. We're talking about the basic title insurance. The basic title insurance, one thing that they do cover is a forgery in the chain of recorded title. It will cover forgery. So the correct answer is for 25 is A, a forgery in the chain of recorded title. It will not cover liens or encumbrances not disclosed by official records. It will not cover rights of parties in possession of the property, and it will not cover actions of governmental agencies regulating the use or occupancy of the property. So these are 25 questions actually released by the Department of Real Estate, and the answers that they didn't give you, I hope I helped you out with by being your appropriate resource. And hopefully this gave you a good idea of if you know this material. These are concepts that are pulled from the 7 areas that the state will ask you on. Thanks for watching. I hope this video was helpful in your licensing journey and your studies. If you liked it, make sure to give us a big thumbs up as well as subscribe to our YouTube channel so we keep producing new content. But if you have any questions or if you'd like to check us out for completing coursework to be eligible to take the state exam or even for preparation to help you prepare for the state test, we have tons of options and I have our website listed below. Otherwise, I'm Schyler with Accredited Real Estate Schools, and thanks for watching.